If you're a sole proprietor, your entire tax life lives on the one form, Schedule C. It's 2 pages, it looks simple, and most people treat it like a chore they deal with once a year. But this form is the financial story of your business. Every number on it tells an examiner something, whether your income is fully reported, whether your deductions hold up, and whether your records can support what you claimed. When I was at the IRS, Schedule C was where I spent a good portion of my examination time. It didn't matter whether it was a plumber or graphic designer or someone running an Etsy shop. The story of the business was on that form. Today, we're covering everything you need to understand about operating as a sole proprietor, how Schedule C works line by line, the self employment tax calculation that surprises every new business owner, and the specific areas where I've seen the most problems from both sides of the desk. Welcome back. I'm Lauren Twitchell, enrolled agent, founder of Zero Fluff Books, and former IRS revenue agent in the small business and self employed division. Most people start as a sole proprietor because there's no barrier to entry. No filing fee, no lawyer, no operating agreement. You just start earning income and you're in. But that low friction is also why this is where the IRS sees the most record keeping problems. Because it's so easy, because it was easy to start, people assume it's easy to manage. They assume that if they don't have a formal entity, they don't need formal records. That assumption is how audits go sideways before they even start. Before we get into the form itself, I want to make one thing clear. Your bookkeeping system and your tax return need to talk to each other. If the categories in your QuickBooks or Zero file don't map to the lines on Schedule C, you're creating extra work at tax time and increasing the chance that something gets miscategorized. That's how deductions get missed. That's also how deductions get claimed that shouldn't be there. Let's start at the top of the form. Part 1 is income. A lot of people think their income for the year is whatever shows up on the 10s they receive in January. That's incomplete. Your gross receipts on Schedule C include every dollar your business earned. If you sold something for cash at a market, that's income. If a client paid you through Venmo or Zelle, that's income. If you received a Shopify if you received a Shopify payout that didn't trigger a 1099K because it was below the reporting threshold, that's still income. The reporting threshold determines whether the platform sends you a form. It does not determine whether the income is taxable. All of it is taxable. One of the first things an examiner does during an audit of Schedule C is a bank deposit analysis. They pull every bank statement, add up every deposit, and compare the total to the gross receipts you reported. If there's a gap, if deposits exceed what you reported, you're going to need to explain every dollar of that difference. And I forgot is not an explanation that resolves an examination. If you sell physical products, Part 2 of the Schedule C is cost of goods sold, or COGS. The concept is straightforward, but the timing trips people up. You don't deduct the cost of inventory when you buy it. You deduct it when you sell it. The formula is beginning inventory plus purchases during the year minus ending inventory. What's left is your cost of goods sold. Here's where I've seen this go wrong. A business owner buys $10,000 of inventory in December, deducts the full amount on that year's return, and thinks they've lowered their tax bill. But if that inventory is still sitting on the shelf on December 31st, it's an asset. It hasn't been sold yet. It doesn't belong in cost of goods sold yet. The deduction comes when the product moves, not when you pay for it. If you're a service-based business and you don't sell physical products, you skip Part 2 entirely. Your deductions live in the expenses section. Now let's talk about expenses, because this is where I see most of the problems live. To be deductible on Schedule C, an expense has to meet two criteria. It has to be ordinary and it has to be necessary. Those are the words that the tax code uses, and they mean something specific. Ordinary means the expense is common and accepted in your trade or business. A camera is an ordinary expense for a photographer. It's not an ordinary expense for a dog walker. Necessary means the expense is helpful and appropriate for your business. It doesn't have to be indispensable. The standard isn't, I can't operate without it. The standard is that it serves a legitimate business purpose. If an expense doesn't meet both of those criteria, it doesn't belong on the form. That's the filter. Run every deduction through it before you record it. Now let's get into the areas where I see the most confusion. These are the deductions that seem straightforward until you look at the actual rules. First, vehicle expenses. You have two options, standard mileage or actual expenses. Standard mileage means you track every business mile and multiply by the IRS rate. That rate is designed to cover gas, maintenance, insurance, and depreciation all in one number. The record keeping is simpler, but it's not optional. You need a contemporaneous mileage log. That means you document the trip when it happens, the date, the destination, the business purpose, and the miles driven. If you try to reconstruct a mileage log after the fact using your Google Calendar, An examiner is going to question the reliability of that record. A log created at the time of the trip is credible. A log created 3 years later during an audit is not. Actual expenses mean you track. Actual expenses mean you track every cost associated with the vehicle: gas, oil changes, tires, repairs, insurance, depreciation, and then apply your business use percentage to the total. More documentation, potentially a larger deduction, but significantly more record keeping. Most sole proprietors are better served by the standard mileage method, but whichever method you choose, the documentation requirement is the same. You need a log, and it needs to be maintained as you go. Next, home office. There's a persistent myth that the home office deduction is an audit red flag. It's not, if you qualify and you document it properly. The rule is that the space must be used regularly and exclusively for business. If your office is also where you eat dinner, it doesn't qualify. If it's a dedicated room or a defined area that you use only for work, it can qualify. You have two methods. The simplified method is $5 per square foot up to 300 square feet. That gives you a maximum deduction of $1,500. No need to track utility bills or calculate percentages. It's clean and it's defensible. The actual method requires you to calculate the percentage of your home used for business and apply that percentage to your mortgage interest or rent, utilities, insurance, and repairs. More documentation, potentially a larger deduction. If you're a renter, the actual method often produces a better result because you're deducting a portion of your rent directly. If you're a homeowner, the simplified method avoids the depreciation recapture issue that can come up when you sell the house. Neither method is aggressive. Both are legitimate. The question is which one fits your situation and which one you'll actually maintain the records for. And then there's the personal expense filter. This is where I've seen the most problems both as an examiner and as a practitioner. People try to deduct gym memberships because they need to be healthy to work. They deduct haircuts because they have a client meeting. They deduct clothing because it's what they wear to the office. These are personal expenses. The IRS standard is clear. If the expense is something the general public incurs as a normal part of life, it's personal. You need a haircut whether or not you have a business. You wear clothes whether or not you have a meeting. The fact that the expense happens to benefit your business doesn't make it a business expense. The test is simple. Would you incur this expense if the business didn't exist? If yes, it's personal. Identify these before an examiner does, because they will. Now let's talk about the number that surprises almost every new sole proprietor: self-employment tax. You finish your Schedule C, net profit is $50,000. You estimate your income tax, figure you owe somewhere around 5 or 6,000, and you think you're covered. Then you run the numbers through your tax software and the total jumps to something closer to 12,000. You think there's an error. There's no error. That's the self-employment tax. When you work a W-2 job, you pay 7.65% of your wages toward Social Security and Medicare. Your employer pays the other 7.65%. You never see that half. It's not on your pay stub. When you're a sole proprietor, you're both sides. You pay the full 15.3%. That's calculated on your net profit from Schedule C, and it applies regardless of whether you actually took the money out of the business or left it in the account. The tax is based on what you earned, not what you withdrew. This is the single biggest reason new sole proprietors fall behind on their tax obligations. They plan for income tax and completely miss the self-employment tax. If you're not setting aside at least 25 to 30% of your net profit for taxes, income tax plus self-employment tax combined, you are going to owe more than you expect. Understanding this is foundational to everything else this season. The S Corp changes how self-employment tax applies to your income, but that decision only makes sense once you understand the math at this level first. One more section before we close. I want to take you inside how an IRS revenue agent actually looks at a Schedule C. When I was at the IRS, we worked from the Internal Revenue Manual, the IRM. Section 4.10 covers examination procedures. The tone of the IRM when it comes to Schedule C filers is clear. Documentation is the standard, not explanations, not good intentions, documentation. The biggest trap for sole proprietor is thinking that a simple structure justifies simple records. It doesn't. An examiner doesn't walk in and give you the benefit of the doubt because you're small. Sole proprietors are the most common filers, and the IRS knows they're most likely to have record-keeping gaps. That's not a judgment call, it's a statistical reality, and it shapes how exams are planned. The burden of proof is on you. The IRS doesn't have to prove you didn't spend that money. You have to prove you did. If you claim $5,000 travel expenses and you can't produce the documentation, the examiner disallows the deduction. They recalculate your tax, they assess penalties and interest, and you get a bill. When I examined a Schedule C, I wasn't just looking at the numbers, I was evaluating the credibility of the records behind them. A dedicated bank account, clean books, and organized documentation told me the owner took the business seriously. Mixed transactions, no system, and a stack of unsorted receipts told me something else. And once an examiner identifies one unsupported dedu- and once an examiner identifies a deduction, they start looking for the rest. Here's the bottom line. Schedule C is the foundation. If this form is messy, if your categories are vague, your income is underreported, or your deductions can't be documented, nothing else we talk about this season will work the way it's supposed to. An LLC doesn't fix bad records. An S Corp election doesn't fix bad records. The structure is only as strong as the bookkeeping underneath it. Before next week's episode, open up your bookkeeping file. Look at your expense categories. Do they map to the lines on Schedule C? Do you have a clear category for advertising, office expenses, travel, supplies, and contract labor? Or is everything dumped into miscellaneous and other? If it's the latter, clean it up now. Next week, when it's time to move beyond the sole proprietorship and what a single member LLC actually does and doesn't do for your taxes, if you're thinking about forming an LLC or you already have one and you're not sure what changed, that episode is for you. I'm Lauren Twitchell. Keep the fluff out of your books, and I'll see you next week.